Today, I want to talk about how UBS has been sued and fined over $250 million for Credit Suisse's illegal crimes. Credit Suisse allowed Archegos to synthetically short companies and failed to margin call them when they breached margin requirements, causing giant losses not just for Credit Suisse, but for other major banks too. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Frank tweeted saying the Federal Reserve Board announces a consent order and $268 million fine for UBS Group AG for misconduct by Credit Suisse. The misconduct involved Credit Suisse's unsafe and unsound counterparty risk management practices with Archegos. In 2021, Credit Suisse suffered approximately $5.5 billion in losses because of the default of Archegos, an investment fund. During Credit Suisse's relationship with Archegos, Credit Suisse failed to adequately manage the risk posed by Archegos despite repeated warnings. The board is requiring Credit Suisse to improve counterparty credit risk management practices and to address additional long-standing deficiencies in other risk management programs at Credit Suisse. So I wonder which other clients they're allowing off the hook with those bad risk management processes, and I wonder which other clients they haven't yet margin called. I wonder if it's any other market makers that we know, beginning maybe with C and ending in Citadel. The board's action is being taken in conjunction with actions by the Swiss Financial Market Supervisory Authority and the Bank of England's Prudential Regulation Authority, and the penalties announced by the board and the PRA total approximately $387 million total. It also says that Credit Suisse has a prime services business, mainly catering to hedge funds and institutional investors. And the Prime Services Risk Department handled daily risk management tasks, including setting margin rates. But Credit Suisse took no effective action to mitigate risks posed by Archegos' portfolio. They also didn't obtain enough margin or collateral from Archegos and didn't effectively manage data quality for risk metrics. Now I want to briefly explain how a margin call works and how Credit Suisse failed to margin call Archegos and how that led to a giant loss not just for Credit Suisse but other banks as well. Now I've shown a similar example of this for Citadel, and that's why the numbers may seem slightly familiar. But let's assume Archegos or Citadel has their own equity of $50 billion. They take on a $200 billion margin loan from Credit Suisse, or maybe it's from Bank of America or any other prime broker. That gives them a total portfolio value of $250 billion, $50 billion of their own equity, and $200 billion in margin loans, giving a leverage ratio of 7-1, the same as what Citadel uses. Now let's say Archegos, as a result of bad investing, takes on a $40 billion loss. Let's say that's as a result of shorting AMC and GameStop during 2021. Now that $40 billion loss, as you can see by following that line, is absorbed entirely by Archegos. Their $50 billion of equity takes a $40 billion hit, and Credit Suisse doesn't lose a single penny. And theoretically, if Archegos loses $50 billion on an investment, they would still absorb 100% of that loss, which would wipe out their entire equity value. As soon as they lose $50 billion and 1 cent, that is when they should be margin called by Credit Suisse. For example, if you or I are investing on margin and we take a loss that's the same size as our total cash balance or total account value, as soon as we exceed that by 1 cent, we are instantaneously margin called. No ifs, no buts, either deposit more cash or receive a margin call. But the problem here, and why Credit Suisse and other banks lost so much money, is because they gave Archegos a lot of leeway. And that may be exactly what is happening with Credit Suisse or Bank of America and with other hedge funds or market makers like Citadel. For example, Archegos took a $60 billion loss. They've already lost the full $50 billion of their entire equity value, and Credit Suisse took that $10 billion loss themselves. They said, it's all right, we'll give you a bit of leeway, we'll take this $10 billion loss, just try and invest and make it all back and pay us a bit extra on the side. But obviously, let's assume Archegos lost $100 billion. Obviously, their entire $50 billion equity value is already wiped out, so Credit Suisse has to brunt and bear the loss of $50 billion. Now, obviously, that is a massive loss, and this is exactly why Credit Suisse is being fined so significantly, because they didn't margin call Archegos when they should have. Instead of absorbing that $50 billion loss by themselves, they let other banks like Nomura and Goldman Sachs take some loss as well. Either way, they still went against policy and against regulations and allowed Archegos to continue investing even though they'd failed margin requirements and were likely just taking some money under the table to let it slide. And as I said, this is possible or is likely exactly what is happening with other hedge funds as well. Especially as this article literally says the board is requiring Credit Suisse to improve counterparty credit risk management practices and to address additional long-standing deficiencies in other risk management programs. So there is additional long-standing deficiencies with other clients. Now, Frank has also tweeted saying that AMC is still number one of 7,720 companies worldwide for their cost to borrow fee. The AMC cost to borrow is still over 1,000% at 1,026%. You can see the next largest companies in terms of cost to borrow are only at 600 and 500%. AMC is still maintaining this crazily high cost to borrow fee of over 1,000%. And I actually found that really interesting because I was wondering when AMC's cost to borrow started to rocket this month or last month, and how long has it remained elevated for? We can see from this chart again from Frank, the AMC cost to borrow started to run all the way back on the 3rd of July, when the cost to borrow reached nearly 900%. So that basically means so far the AMC cost to borrow fee has stayed at or around 1,000% now for 23 days. Obviously, prior to the 3rd of July, it was still around 100 or 200%, but that is smaller than 1,000%. So let's just take the days where it stayed at or around 1,000%. With 1,000% cost to borrow fee, that means these hedge funds and institutions are paying 2.7% interest per day to borrow AMC shares. Multiplying that out by 23 days is 62.1% interest. So far, literally in the month of July, these hedge funds have lost 62% of their entire short position, or all of the money they put into that short position, just by borrowing AMC shares. So if this AMC cost to borrow fee stays elevated for another 20 days on top of that, the shorts will have lost 100% of their entire short position cash input. I guess if you factor in weekends, it's something like only 15 days so far. So in another 20 or 40 days, including the weekends, this cost to borrow fee will exceed 100% of their total short position. If they spent $5 billion shorting AMC, then by mid to late August or early September, they will have lost the entire $5 billion. So far, these hedge funds are expecting AMC to go bankrupt literally in the next 10 days to make a 100% profit on their short position. If it doesn't go bankrupt in the next 10 or 20 days, they start losing money. Now, Robert has also tweeted about the shills trying to convince you to sell AMC shares around $100 per share. Again, I think this comes after the article from yesterday where Goldman Sachs gave AMC a price target of $175. This was either A, to try and convince you to buy options now, wasting that options premium, or trying to slyly convince you to sell at $175 per share instead of holding longer. They're trying to bait you into thinking $175 is the maximum and trying to bait you into selling early. And that seems exactly what these comments on YouTube are trying to do. We're already seeing comments saying AMC's new floor is now just $100, saying we want this to end already, saying these hedge funds are very intelligent people and we should not be greedy and we should be happy with $100 per share, saying that Lou versus Wall Street is right and we should probably sell at just $100. Again, this is just more shill comments trying to convince you to sell your AMC shares either now or to sell your shares early during the squeeze. Obviously, I can't tell you what price to buy and what price to sell at, or tell you when to buy and when to sell. That needs to be up to you. But I do believe AMC can go higher than $100 per share, especially when we look back at Volkswagen back in 2008. Especially when you then factor in that Volkswagen was not likely synthetically shorted and was not likely synthetically shorted for the previous 2 full years. But as I said, obviously it needs to be your decision when to sell. I've only suggested in the past to sell in multiple different bracket price points so you don't miss the squeeze entirely. Maybe have different brackets between $100,000 and $50,000 per share where you sell multiple times up during the squeeze. And on top of that, Travis has tweeted saying, like I said, this is why they don't want the conversion and reverse stock split. He said naked short sellers sold AMC and that fictitious fake AMC share created another fake ape share. And that is why the naked short sellers cannot deliver that created AMC share and also won't be able to deliver that created ape share when it converts into AMC. ChatGPT says if there were naked short sellers involved in the preferred equity units before the conversion, they would have sold the units without actually holding them or locating them. Upon the conversion of the preferred equity units to common stock, the naked short sellers are now obligated or obliged to deliver the equivalent number of common shares they had previously sold. However, since they never owned or borrowed the preferred equity units they sold, they may not have the corresponding common shares to deliver. Basically saying that for every synthetic ape share that has been created, that will basically create another synthetic AMC share during conversion and increase the number of FTDs. Again, increasing those FTDs leads to a further increased cost to borrow fee, leading to just even more expenditure for these shorts. As ChatGPT says, it says the naked short sellers may fail to deliver the required number of common shares on the settlement day. And this failure to deliver can result in regulatory actions, not likely, penalties, again not likely, or other legal consequences, which it would do if the SEC wasn't paid off. But if the naked short sellers cannot deliver the common shares they sold, the buyers of those shares may request forced buy-ins. This means that the buyer's broker will purchase the common shares on the open market to fulfill the delivery obligation, and the naked short sellers will be responsible for any losses incurred in the process. Now this part here is actually quite interesting because it basically means for any FTD created or for any additional FTD created, the naked short seller is 100% responsible for any and all losses incurred and needs to pay for those shares and the borrow fees and for the FTD as well. Again, just way more expenditure for these shorts that they already cannot handle. As I've said, we already have this crazy cost to borrow fee that these shorts already cannot handle over 1,000%, which is obviously leading to even more banks giving hedge funds and market makers more and more leeway, creating even more losses when the squeeze eventually happens. The amount of money Bank of America will lose when Citadel collapses will make Credit Suisse and Archegos look like peanuts. But guys, be sure to let me know what you think down in the comments below. As always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.